Should you buy Disney stock? Disney is an iconic company that has multiple revenue streams. In 2022, the company made $28.7 billion in revenue from its parks, experiences and products, and $55 billion in revenue from its media and entertainment segment. That media and entertainment segment can be further broken down into linear networks, direct-to-consumer and content licensing. Linear networks includes a long list of TV and cable channels. Direct-to-consumer accounts for Disney's streaming services, and content licensing represents the sale of content to third-party providers. As you can see, Disney Parks brought in $7.9 billion of operating income in 2022. Linear networks generated $8.5 billion, streaming produced a loss of $4 billion, and content licensing lost $287 million. Add it all up and deduct total costs and expenses, and net income over the last 12 months was only $3.1 billion on total revenues of $83 billion. Compare that to 2019 when Disney earned $10.4 billion of net income on revenues of only $70 billion. In other words, Disney revenues have grown 19% in 3 years, while net income has dropped 81%. Meanwhile, Disney has a current enterprise value of roughly $220 billion. That means the stock is valued at 2.7 times sales or 86 times earnings. These numbers are so skewed because Disney is investing heavily in its streaming services. The company spent $25 billion on content alone in 2021 and should spend $33 billion in 2022. Overall, costs and expenses are a third higher than they were in 2019. To be fair, heavy investment in streaming is the right move and Disney is seeing some success. Disney's 235 million subscribers recently overtook Netflix's 223 million, and management said the service should generate meaningful profits by 2024. Let's assume that parks and streaming grow 10% a year for the next 5 years. Linear shrinks to $5 billion in revenue and content licensing grows to $10 billion. Total revenue in that scenario would be around $93 billion, and a 20% EBITDA margin gets us to about $19 billion in EBITDA in 5 years' time. Apply a 20 times multiple to that figure and we get an enterprise value of $380 billion, which works out to an investment return of 11.5% per year. Disney could do better than that if its streaming services are a big hit and margins get back to 25 or even 30%. But streaming is highly competitive and there are some questions over management. Disney also has a fair amount of debt thanks to its 2019 acquisition of 20th Century Fox. Disney is approaching its centenary year with the stock price back to 2015 levels, and it does look like a decent time to buy. But the upside doesn't look large enough, which is why I give the stock a neutral rating. But these are my personal opinions, not financial advice, and I do own some shares in Disney. For more detailed analysis, visit our website.